Welcome to our video on when do-it-yourself tax filing crosses the line and when it's time to hire a professional. Today, we will explore the tipping points that turn a straightforward return into a high-stakes filing, the impact of side gigs and 1099 income, how major life events affect your return, and how to choose between a CPA and an EA. We'll also give you a record-keeping playbook, a documents checklist, and quick quizzes to test your understanding. Let's begin. Here's our roadmap. First, we'll define the DIY tax threshold and why it exists. Next, we'll discuss how receiving a 1099 effectively means you're running a business and the implications of Schedule C and self-employment taxes. Then, we'll outline record-keeping best practices and common deductions. After that, we'll cover life events that complicate tax filings. We'll compare CPAs and EAs to help you choose wisely. Finally, we'll give you an action checklist and a timeline to stay on track. Let's proceed. Before we dive in, a quick but important disclaimer. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Everyone's situation is unique, so please consult a qualified tax professional who can evaluate your specific facts before making filing decisions. The key concept is the DIY tipping point. Tax software is excellent for straightforward returns with 1 or 2 W-2s and the standard deduction. However, when you introduce 1099 income, multiple W-2s, divorce, dependents, head of household status, bankruptcy signals, or significant itemized deductions like mortgage interest and large charitable gifts, the complexity increases quickly. At that point, you should strongly consider engaging a professional to minimize errors and maximize legitimate savings. Here are the most common signs that you've crossed the DIY threshold. Receiving a 1099 from freelance or gig work, handling multiple W-2s due to job changes, claiming head of household, navigating divorce or bankruptcy, itemizing because of mortgage interest and significant charitable donations, purchasing equipment that may require depreciation strategy, and needing a plan for estimated quarterly tax payments. Each of these significantly increases the chance of calculation errors and the risk of missing opportunities without professional guidance. If you receive a 1099, the IRS generally treats you as operating a business. That usually means you will file Schedule C and pay self-employment taxes that include Social Security and Medicare components. The upside is access to important deductions, such as home office, mileage, equipment, and a portion of utilities. However, these deductions require careful documentation, receipts, logs, and ideally separate banking for business transactions. Additionally, software may not optimize depreciation choices, which can materially affect your tax liability. Here is a practical system to keep you compliant. First, open a separate bank account to cleanly separate business transactions. Next, set up a chart of accounts covering the major categories you will report. Use a mileage app to log miles with purpose and odometer readings. Save receipts, adding notes about who, what, when, why, and the amount. Measure your home office and confirm that the space is used exclusively and regularly for business. Record equipment purchases with cost, date, and business use percentage. Set calendar reminders to make quarterly estimated tax payments. Finally, reconcile your accounts monthly and back up your records to the cloud. When you buy equipment, you typically have multiple deduction methods. Section 179, bonus depreciation, or MACRS. The best choice depends on your cash flow, expected profitability, and long-term plans. Remember to track business use percentage, especially for listed properties such as vehicles. While large immediate deductions can be attractive, you must be able to substantiate them with records to avoid audit issues. A professional can help you select the optimal approach. Life events add layers of complexity. Multiple W-2s can create withholding mismatches. Head of household status has strict requirements related to dependents and support. Divorce affects filing status and may change eligibility for certain credits. Bankruptcy by itself may not drastically complicate the tax return, but it indicates a non-standard year that warrants professional oversight. Large charitable contributions and mortgage interest often push you into itemizing, which requires careful calculation and documentation. Both CPAs and EAs are highly qualified. CPAs typically have broader accounting expertise and may provide bookkeeping and advisory services beyond taxes. EAs specialize exclusively in taxation and are known for strong IRS representation capabilities. Either credential can be excellent. The key is finding someone experienced with Schedule C businesses who can set up your expense tracking and estimated tax systems. Focus on competence and fit rather than titles alone. Use this documents checklist to prepare for filing or a meeting with a professional. Gather all W-2s, 1099s for self-employment income, the 1098 mortgage interest form, charitable donation receipts, equipment purchase invoices, mileage logs, home office measurements, and bank or credit card statements. If applicable, include divorce or support orders and any bankruptcy documentation. Having these ready ensures accuracy and efficiency. This timeline highlights key moments across the tax year. Early in the year, you receive W-2s and 1099s. In March, organize records and determine the best depreciation strategy for any assets purchased. By April 15th, file your return or an extension and pay any balance due. Quarterly estimated taxes are generally due in mid-April, mid-June, mid-September, and mid-January of the following year. Throughout the year, maintain logs for mileage and home office, and keep your bookkeeping up to date to avoid a scramble at tax time. Quiz time. The question is, if you receive a 1099 for your side gig, what does that typically mean for your tax filing? Option A, you can ignore it if it's under $600. Option B, you're considered a business and will likely file Schedule C with self-employment taxes. Option C, it counts as hobby income with no taxes. Option D, you should always file as head of household. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Receiving a 1099 typically means you have business income that should be reported on Schedule C and that you owe self-employment taxes. This also opens up legitimate business deductions, provided you maintain proper records. Here's the next question. Which statement about head of household is most accurate? Option A. Head of household is available if you had any dependent at any time of the year, with no other rules. Option B. Head of household requires a qualifying person and meeting both support and residency tests. Option C. Head of household is the same as married filing separately. Option D. Head of household is automatic if you pay rent. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Head of household requires that you have a qualifying person and that you meet specific support and residency tests. It is not automatic and is distinct from other filing statuses. Remember these key points. Tax software is strong for simple W-2 situations. A 1099 moves you into business territory with Schedule C and self-employment taxes. Significant deductions require strong documentation. Life events substantially increase complexity. Select a professional with Schedule C experience, whether an EA or CPA. Finally, set up systems early and manage quarterly taxes to avoid surprises. To wrap up, determine whether your situation exceeds the DIY threshold. Organize your documents and improve your record keeping. Decide on an appropriate depreciation strategy with professional input if you have assets. Confirm your filing status, dependents, and credits. Schedule estimated payments and calendar reminders. Finally, consult an EA or CPA before the filing deadline to avoid costly mistakes. Thank you for watching. If this video helped you understand when to switch from DIY to professional tax help, please like the video, share it with someone who needs it, and subscribe for more content. Let us know your questions and experiences in the comments. We'd love to hear from you.